Well, welcome everybody to the 12th annual meeting of the shareholders of First Internet Bank and Bancorp nowadays. The first slide that we pop up will be the regulatory bulletins, getting all the good safe harbor forward-looking statement issues out of the way to put us in compliance with everybody present and the folks that will view it on the web at a later date. A little bit of background for some of the folks here that might be first-time attendees, and just kind of recapping a little bit of the history of the bank. We are a single bank holding company, launched in 1999. Our bank is First Internet Bank, which is located directly across the parking lot, 2 buildings over, up on the 8th floor. We serve a national consumer base. Within 90 days of launching the bank, we had a client in all 50 states across the United States. We have a very proven retail banking platform with what I would view in a lot in the industry, some very unparalleled financial management tools. We are also, over the past 18 to 24 months, moving into kind of a local regional commercial market, both on commercial real estate and commercial and industrial loans, which I'll come back to in a few minutes. Obviously, our history from the beginning of time has been a very low-cost delivery structure, which has allowed us to pay traditionally higher deposit rates and have lower fees and loan interest rates to the consumer marketplace. That is also starting to carry over a little bit into the commercial marketplace for us. As the regulators have told us many, many times over the years, we are not kind of the traditional community bank model by any means. In some respects, and I'll say this more than once through the presentation, we're a little bit of a square peg in the round hole. But we have some key results here that we'll show you the next few slides that kind of compare us to the community bank marketplace and our peers, and you'll see that we're actually moving in the right direction on a lot of those and becoming more and more operating in returns compared to a community bank. In the upper left-hand corner is return on average assets. Historically, we had been below our peers. I guess point of information, the green line is First Internet Bank, the blue line is community banks, or those classified as our peers. 2010, we kind of jumped ahead of them. We evened out in 2011, but for return on average assets, we have now caught up to the traditional banking community. On return on equity, in the lower left-hand side, we actually again passed traditional banks in 2010 and continued in that position in 2011. So we're leveraging our equity and getting a higher return than traditional banks. Net interest margin is a little different story. We have closed the gap. Over the years, we were closer to a 2% net interest margin. So over the last 4 or 5 years, in part because of the mortgage services side, I'll come back to in a few minutes, the mortgage product, we've been able to narrow that gap, and we're getting closer to banks, very close at the end of 2010, had a little slide in 2011, but all in all, a much better net interest margin than we've had historically. Bottom right-hand corner, most of you familiar with the banking community know the Texas ratio is kind of a indication of the quality of assets on the books of the bank. In this one, the lower the number, the better. We're sitting at a Texas ratio under 20% a year, and compared to our peers, north of 30%. So a good statement about the quality of the assets in the portfolio we're running on the lending side. Now I'll take a quick look at the calendar year 2011 and a little bit into the first quarter of 2012. It was, in all aspects, just a tremendous year for the bank in 2011. It's all highlights, all good news. Record assets. We finished the year at $584 million. We have since, and I'll come back to the slide in a second, top $600 million here in 2012. We had growth in both the loans and the deposit side of the balance sheet. We did have a little help on the loan growth side. We did purchase 2 pools over the course of the year, a mortgage pool from the West Coast, as well as a small commercial pool from a local insurance company here in town. But we have generated tremendous internal asset growth on the loan side. Added staff, more to come on that later in the presentation. Did a lot of upgrades in the software and the infrastructure of the bank, and we're really positioned to double down kind of where we're at today. We've built the infrastructure to take us from that $600 million to $1 billion plus organization without a lot of asset investment. Closed 38% more mortgages than we did in the prior year. That has provided a tremendous revenue stream for us and maintained asset quality through the process. We're not growing by moving further and further down the food chain. We're keeping very high quality of assets and services within the bank. This is kind of a year-over-year comparison for you. The assets grew by almost $81 million, from roughly $503 million to $585 million. Loans grew by $70 million. The security and investment portfolio, the green line, increased by $12 million. And the equity, which is a real bottom line piece of the bank, increased by $6.5 million. First quarter of 2012 is kind of more of the same, actually. Tremendous quarter for us coming out. I would vouch that we had a good head start. The first quarter of 2011 was one of our best, so beating it was relatively easy to do, particularly with the mortgage growth and the income side that we have, but income literally more than doubled. First quarter 2011, we had $532,000 in income. First quarter 2012, we're at $1.1 million, so a tremendous move up. Assets continue to grow. Year over year, we're up about $76 million. Non-interest income is where the real kicker comes in. First quarter last year, we made $320,000. First quarter this year, we made over $2 million, and most of that is attributable to the mortgage origination department. Tangible book value continues to head in the right direction. We've jumped from $23.81 per share at the end of first quarter last year to $27.30, an increase of $3.50, or roughly a 15% growth in tangible book on an annualized basis.